Hi there. Welcome to The Street on BNN Bloomberg. I'm Lindsay Biscaya. Coming up on the show today, Dan Rahinton, portfolio manager at IA Global Asset Management, is our guest co-host. He will help us break down the latest tariff turmoil. Then in 30 minutes, Stats Canada is releasing inflation data for December, and Charles St. Arnaud, chief economist at Service Credit Union, will help us make sense of those numbers. And we're looking at why tech talent is leaving Canada with Red Thread social founder Mai Trin. And of course, we want to hear from you this morning on First Call, so you can call us with your questions on large cap, global, and Canadian equities. And we'll have Dan Rahinton answer as many of them as he can at the end of the show. That number to call will be 1-855-326-6266. Phone lines open in about 30 minutes from now. And our email address is firstcall@bellmedia.ca. Now, here's some of the stories we're tracking for you in the BNN Bloomberg newsroom. The European Union is weighing tariffs on 93 billion euros of U.S. goods after U.S. President Donald Trump threatened new levies over Greenland. Brussels has also frozen approval of a U.S. trade deal as it prepares potential retaliation. And we're watching gold and silver today as the two metals are surging to new record highs. This comes as U.S. tariff threats tied to Donald Trump's Greenland push rattled markets. Investors are moving over to metals amid fears of a U.S.-Europe trade war and a weaker dollar. And Barrick Mining has appointed Helen Tsai as its new chief financial officer. Tsai will become CFO on March 1st. Barrick's current CFO, Graham Shuttleworth, will be leaving the company once its year-end financial results have been filed. But now to our top-line story today. There is growing fallout and reaction over a major escalation in Trump's quest to own Greenland. CTV's Jeremy Chiron has the latest today.
It is this massive Arctic island U.S. President Donald Trump insists the U.S. needs to own, but Trump's push to punish allies in his quest to take over Greenland is being met with trepidation.
It's a serious situation, and we're concerned. We're concerned about this escalation, to be absolutely clear.
Prime Minister Mark Carney defended Greenland's sovereignty and security today, insisting Canada's position hasn't changed.
The future of Greenland, decisions about the future of Greenland, are for Greenland and Denmark to decide.
In a Saturday night social media post, Trump threatened tariffs on 8 countries until a deal is reached for the complete and total purchase of Greenland. Sparking today an emergency meeting of European Union ambassadors in Brussels, a joint statement by the 8 countries says tariff threats undermine transatlantic relations and risk a dangerous downward spiral. We will continue to stand united and coordinated in our response. We are committed to upholding our sovereignty. Trump's threats could be a potentially dangerous test of the U.S.'s partnerships with European allies.
It runs the very real risk of doing lasting damage to the NATO alliance, to the cohesion that is so important.
Trump's Treasury Secretary repeating today in an interview with NBC's Meet the Press that owning Greenland is essential to U.S. national security.
Peace through strength, make it part of the United States, and there will not be a conflict because the United States right now, we are the hottest country in the world. We are the strongest country in the world. The Europeans project weakness. The U.S. projects strength.
Denmark continues to pursue a diplomatic way forward with the U.S. over Greenland and is meeting with fellow NATO members to discuss the alliance's Arctic security strategy. Jeremy Chiron, CTV News, Ottawa.
And for more on this, let's bring in our guest co-host, Dan Rahinton, portfolio manager at IA Global Asset Management. Good to have you in studio. Thanks for coming in. I don't know if there's a Monday yet in 2026 where we've come in without, real breaking news around the world. This is really interesting. You say this confirms what we're seeing between the U.S. and Europe today, confirms that really no trade deal is safe.
This is really about China. And let me unpack that a little bit. So when you think about first, let's remember January 18th is when Davos starts. So that's where everyone goes to Switzerland, goes for some nice skiing, and then talks about how to manage the world. You know what I mean? So that's a timeline to have a conversation with the United States and the rest of the European Union countries. Denmark is a very staunch ally. The U.S. can surge troops to whenever they want to Greenland. So this is not about Greenland. This is about forcing the European Union to basically hive off China as a trading partner and go back fully into the Western perimeter, if you will, and basically force the Europe to militarize faster so that they can handle the Russia threat more directly and handle their own internal affairs. This is about disengaging militarily from the European Union so they can focus their efforts more on the Chinese theater, which is in the Asia-Pacific Rim. So this is about the veneer of Greenland. Everybody understands that 80% of Greenland is complete ice cap. So there's no mining going on in any of Greenland. By the time you get to 2100, maybe some northern sea routes are open. So this is not about a part of the Arctic Circle in the way that's being talked about. This is used as a strategic bargaining chip to say, if we'll take this and there's nothing you can do about it, so ante up, spend more on your military, and defend your own direct theaters of influence, and we're going to disengage and focus on China. That's my theory.
That's your theory. What does that mean for Canada then? I mean, also because Mark Carney says he's considering sending soldiers into Greenland for military exercises, but also if you say this is about China, like Canada just signed a couple, or is in talks with China about signing a couple trade deals.
Yeah, I don't know if this is going to go well for Canada in a few months' time. So there's a reason why the initial deal signing with China, there was very little reaction by the U.S. administration.
Yeah.
So don't be surprised if we see the same shock and awe that we see in a few months that we saw, because remember the NAFTA, the renegotiation, it's not exactly that detailed and that it's a removal from, but mid-year is when that timeline hits for us. So us signing deals with periphery partners around the world, let alone potential adversaries as the U.S. sees it, and letting them into the U.S.'s backyard, which is the North, that is Canada. That's not going to go well in the future negotiations. So we might be stepping into the same Greenland blunder. So it doesn't matter how many paper straws or dog sleds we send over there. It's really about some of the things that we're independently doing right now.
Okay, regardless of what maybe the bigger grand scheme is by the U.S., we're still seeing more tariffs, this time on 8 different European nations. What impact do you think that might have on the markets or particularly on Canada?
I think actually the market's pretty well accustomed to trade shocks at this point.
Yeah.
And there's the ability to pass it through if you're generally speaking a well-positioned business. So the impact on trade diminishes the longer it happens. So it goes back to, is there a transshipment corridor that runs through Europe where it's made in China goods with a made in France badge stuck to it? Sorry, Louis Vuitton or Hermes, where that basically happens.
Yeah.
And then it's shipped over to the United States. If that transshipment route, that's one of the areas where it's potentially vulnerable. More often than not, the other critical industries, think of aerospace, it's not in the US's interest to disrupt that relationship with France or the UK or some of those critical industries, because the US understands strategically the role that they have to play. So if you're some fringe discretionary good, then maybe tariffs are a real and eminent threat for you. If you're a strategic industry, just look at what happened with Taiwan. The US signed a deal with Taiwan, and the TSMC promised to build more fabs in the United States. Clean. So it doesn't always have to be a breaking of the trade barriers. So that's why I keep saying, when it comes down to Greenland, it's not about this piece of the North Pole, basically. It's about the Europeans being forced to ante up on their own domestic affairs and domestic theaters and joining the U.S. in quarantining China in the global stage.
Okay, just so much to watch for. Dan, obviously you're sticking around. We're going to take a quick break, though. Up next, we'll take a look at markets before the bell, and we'll dive deeper into the software sector. Stick around for that. Welcome back to The Street. We're going to take a look at how markets are faring today, beginning with how Asian markets finished the day, because, of course, they're done trading due to that time change. You can see mixed trading over in Asia today. The Nikkei finished down, same with the Hang Seng. The CSI 300, though, up by very, very minimal 0.05%. If we move over to Europe, though, this is where things are getting interesting. European markets falling sharply today. The Stock 600 is on track for its worst day in 2 months. You can see these markets down. Of course, this is because of that back and forth going on between the U.S. and Europe. Trump imposing those 10% tariffs on 8 different European nations because of their opposition to the U.S. planning to take control of Greenland. And we're watching that closely today. U.S. markets also trending down, although, of course, U.S. markets are closed today because it's a public holiday. If we take a look at where the TSX finished the day on Friday, it finished up by 0.04%. So not by too much, but up more than 33,000 points. And if we look at the biggest winners and losers on the TSX Composite from a percentage standpoint on Friday, MDA Space was up almost 15%, Silvercorp Metals up more than 10%. And if we look at the two biggest declines on the TSX on Friday, Fairfax Financial was down more than 5%, Capital Power down almost 7%. And we'll take a look at the price of metals this morning. Gold, silver reaching new record highs amid all this turmoil happening between the U.S. and Europe. Investors obviously looking for that quote-unquote safe haven when times get tough geopolitically. Copper is also resuming its gains today, heading toward 13,000. We'll be watching that closely. And we'll take a quick look at the price of crude oil this morning. It is down, WTI oil down by 0.6%. We are seeing a weakening in the software sector to kick off the new year. So what's the reason behind this decline? IA Global Asset Management Portfolio Manager Dan Rahinton is with us this hour to talk about it. So Dan, what is going on with the software sector to start the year? It's down quite a bit. Yeah, and this has been after a tough last year and a bit of a weird year the year before that, right? Mm-hmm. So this is a multi-year trend at this point. And what we're really seeing is we're seeing the fundamental shift in how software is consumed and also, more importantly, how software is built. So the introduction of what these LLMs, AIs, or what I like to call them foundation models are doing is they've made the barriers to entry to create the next Salesforce, to create the next tool significantly lower. So back then, if it was 10 years ago, you needed $100 million to start, you needed to hire 50 people, on your way to 500, on your way to 5,000. You needed scale, you need dollars. Now, a tech nerd with these tools in their basement can create something close to the same efficacy as a sophisticated software tool. That is a barrier to entry break that we haven't seen in a generation. And software stocks are starting to see it one by one. And I'll say Adobe started first down this pipe, and we're seeing the rest follow. Adobe was first because of what OpenAI launched called DALL-E. It makes images. So rather than tinkering on Photoshop or Lightroom, little things here and there about the image you're trying to perfect, if you can just type it and it just spits out a new image for you that's close enough, that tells you the direction of travel. So Adobe started first. Now we're moving on to the Intuits of the world and the rest of the software space. So we're going to see a huge differentiation between, are you fundamentally locked in or are you a discretionary purchase in software? And that's going to be the decision on whether you invest in these companies or not. But right now, it's too early. Okay, then I guess maybe it's too early for this next question too, but is this the demise of software then, or is there still a place in the future for software to work alongside AI and all these other big tech sectors that are coming out? I'll take it a different way. It's not the demise of software, it's actually the imminent explosion of software. It's just not in these publicly listed companies. Because if you can create your own software because you have a certain planning tool that you want to use, or you want to try, if you're a product manager at a mid-sized company and you just like it done this way and Salesforce could never just do it the way you wanted it to, you can spend a weekend and code it up yourself. So that's what we're seeing. And the rents will go to the future IPO'd companies that are Anthropic, OpenAI, and then you can own part of it through Google, but Google's more of a consumer app on the AI side. So then I guess there's no, if you're saying like for public software companies, you're kind of seeing that downward trend. There's no public software companies, obviously, no stocks that you're watching. Like you mentioned, Adobe has been dropping, and we saw that one-year chart coming up. But is there anything else you're watching for that maybe could take a turn? Yeah, there's a price for Intuit, 20% lower. There's a price for Salesforce when it's at like trading like a value stock, like in the low teens, and they cut back on their stock-based comp a little bit, which is still quite aggressive. There's a place for these companies. But I think the important thing to understand is the walls are down. It's not the same competitive moats as it was before. So the valuation regime is fundamentally different. These stocks, as a basket, used to trade at something like 55, 60 times earnings back in the day. Now they're in the mid to high teens, maybe in the low teens, where they get discipline on costs and where they get discipline on financial return. They could be interesting investments, but you're operating under the assumption that every year you get chipped away a little bit by Anthropic and OpenAI. So you talked about, how there needs to be some kind of adjustment, right? Can you go a little deeper in terms of what that adjustment should look like or might look like? Yeah, and I'll be a little bit more detailed than usual. So you should basically look as a software company heavily at your costs, because the story was always our gross margins are really high, 70, 80, 90%.
but our operating margins are 15%. And that's because there's a huge layer underneath called the product manager, the salesperson, that's paid huge quotas to go golfing, pay for dinners, to basically say, buy this multi-year integration into Salesforce, as an example. That product manager layer is going to see massive cuts as we look ahead, because that's the only natural step to go, and the go-to-market function for Salesforce is going to be different. They haven't fully learned that yet, because they're still trying to live in the old world, but I think that's where it's going. And the second thing is stock-based comp is going to come down too, because the generous pay that you earn by selling and booking these big deals as a software sales rep, those are going to get cut. So will your stock grants. That means there's more free cash flow for Salesforce to buy back stock or basically introduce a dividend more so than they have. So it's a cost rationalization and a capital discipline in a way that we haven't seen from software yet, but I assure you it's coming because there's no other choice.
It's so interesting how AI has kind of changed and is changing the market. Like, I wonder if there's other sectors other than software that we're really going to see. And maybe you can't answer this, but it does seem like AI is really starting to change other sectors and the way everything kind of works together.
This will fundamentally change white-collar work in a way that we've never seen before. And the best way to think about it is there's different eras and different things that have happened through time. So most people in the big cities working in knowledge industries, you'd be forgiven for thinking that globalization and 2001 China entering the WTO was an event for you because all your stuff just got cheaper. But if you were a factory worker or in building these things, it was a depression for you and you never came back. Mm-hmm. That's a bit draconian of a lens to take, but this is going to impact knowledge work in the same way that China's entry into the WTO impacted blue-collar manufacturing work all across America and North America to expand it out, including Canada. So that's what's coming. That means it's going to be cheaper to get knowledge. It'll be cheaper to get knowledge work done. So lawyers, accountants, educators, doctors, this is the technology that is going to fundamentally change your jobs.
Interesting stuff. Okay, we're going to take another quick break. We will be back, though, with Dan Hinton to see why Netflix is on his radar. That's coming up right after the break. Welcome back. It's time now for On the Radar, and we're back with Dan Hinton, portfolio manager at IA Global Asset Management. Okay, a couple stocks in your radar, Dan. We will start with Netflix. Of course, they're reporting earnings this week, I think. So what are you watching for?
Yeah, so there's a few things. First, how's their advertising rollout going, which is basically them down-tiering and allowing users that don't want to pay for the premium package to step in. The second one is around the idea of what's their actual plan for the Warner Brothers transaction and the process there. And the third one, and this is one of those things that's going to come up not just for this conference call, which is a maybe of a toss-up, but as we look ahead. Short-form content, the ability for AI-generated content. Like, we didn't talk too much about the media landscape in our last segment, but for Netflix, they have big budget productions. This is basically the new Fox, the new Hollywood mega studio. Now, if it's a lot easier to talk about and build content at a fraction of the cost, do we see a re-balkanization of the media landscape, just as Netflix basically devoured all of Hollywood? And that's something for Netflix that's a strategic threat that they can't really do much about, because it's just a lot easier for a tiny producer with a small budget to make something happen. Otherwise, he'd have to go begging and pleading for Netflix to say, can you please fund this and give me $10 million?
When you look at that chart, that Netflix chart we just had up, it was like a one-year chart. You saw it go up in the middle of the year. It's down right now. That seems kind of appealing to you. There, you can see it there. Kind of appealing given...
I think it's interesting. I think it's an interesting stock. I don't think it's overly expensive. I think it's actually pretty reasonably valued. But these are, once again, they go back to bigger questions to ask. But directionally, I'm a buyer of Netflix. I just want more comfort that their media and content strategy allows for the long tail of producers, which is where this is inevitably going. Because right now, YouTube is where that's scooped up.
Okay, so the biggest competition, you'd say, is YouTube.
100%.
Okay.
Yeah, and short-form video.
Okay,
TikTok.
Yeah, true. Okay, next up is Intel. I believe we've talked about Intel before. You like this one?
Yeah, so Intel's interesting because we like TSMC just because of the durability and the stability, but Intel is where the spillover demand goes. So what's been going on, once again, the AI theme comes up very much alive and real here, is Intel is where the empty fabs are, because TSMC is fully booked up. TSMC just recently raised their capex. That's why Intel stock has gone from a decent run from the 36 level, is the belief that TSMC is fully sold out, which means the next place that the design companies have to go, your NVIDIAs, your AMDs, your Apples of the world, they're known as the design companies, they have to go to Intel because they have excess capacity in 18A. Intel is a toss-up. Intel does have capital risk, but it's backstopped by the US government, and it's very clear that there's 3 global foundries that matter. Taiwan Semi, Intel in the US, and SMIC in China. And that's where all of the bleeding edge logic and chips are going to be built. And that's why I think Intel is something to definitely watch to see how much of that spillover compute they're going to get.
Okay, last up, United Airlines. What do you like about United Airlines?
So what's interesting about United Airlines is you really learn about the state of the US consumer. We've learned a lot about, or we've heard a lot about what's known as the K-shaped economy. So if you own assets, you're doing really well because we have asset inflation, which is also known as the stock market going up. But if you don't own assets, interest rates are high, food inflation is high, and it's tough out there.
Yeah.
So that's what that K-shaped economy is. United Airlines, we'll see how strong the upper end consumer is, who tends to be the heavy traveler. They buy more premium seats, the lounges, and all those knickknacks on the plane, the headphone, knickknacks being headphones and food. So these days, because that's how far we've come. Yeah. But United Airlines will tell you how the upper end consumer is doing in America, and that'll tell you and help you inform where the direction of interest rates are going.
Is it concerning at all this geopolitical uncertainty we have? Like, I know when the U.S. invaded Venezuela or captured Maduro a couple weeks ago, some U.S. airlines kind of halted flights to the Caribbean for a bit. Does any of that concern you when it comes to United Airlines, or not really?
It'll be a little bit of a hiccup, but this is what non-GAAP adjustments are for, because management teams love that. So they just say, well, we just missed these routes, and if you don't think that another dictator is going to get captured, then take this out of my numbers. Most investors will. So if they have any disruption, it won't be a big deal. If memory serves, United's actually more transcontinental routes as opposed to the north-south corridor to the Caribbean.
Interesting stuff. Okay, still ahead. We're going to take a quick break here, Dan. Thanks for that. Still ahead, Stats Canada is about to release the December CPI numbers. We will take a closer look at the data when that comes out right at 8:30. That's coming up after this. And our phone lines will open soon for our first call segment. You can call us. Here's the number, 1-855-326-6266, or you can send an email at firstcall@valmedia.ca. We'll be right back. The European Union is weighing tariffs on 93 billion euros of U.S. goods after U.S. President Donald Trump threatened new levies over Greenland. Brussels has also frozen approval of a U.S. trade deal as it prepares potential retaliation. And we're watching gold and silver today as the two metals are surging to record highs. This comes as U.S. tariff threats tied to Donald Trump's Greenland push rattled markets. Investors are moving over to metals amid fears of a U.S.-Europe trade war and a potentially weaker dollar. And we are watching shares of Keyera today. The Canadian oil and gas operator says it shut down its Alberta EnviroFuels facility due to a failure of a key component. Keyera says it expects maintenance capital spending to increase by about $10 million, resulting in a revised 2026 guidance range of $140 million to $160 million. And Barrick Mining has named Helen Tsai as its new chief financial officer. Tsai will become CFO on March 1st. Barrick's current CFO, Graham Shuttleworth, will be leaving the company once its year-end financial results have been filed. StatsCan just released its latest CPI data. The consumer price index rose 2.4% year over year in December, up from an increase of 2.2% in November. On a seasonally adjusted monthly basis, the CPI rose 0.3% in December. So here to talk about those numbers is Charles St. Arnaud, chief economist at Service Credit Union. It's good to have you. We've, of course, got Dan Rahinton still in studio as well. Sir, 2.4%, this is above what most economists were expecting. Are you surprised at all?
It's slightly surprising. I think when we look at the details of that, we knew there was some upside pressure in December because of a base effect. If you remember last year, we had the GST holiday on many items, especially on food. That kind of dragged some of the CPI lower, and now we're kind of having some of the payback from that. But when we look into details, it seems like some of the surprise. I was looking at the transportation sector. We knew gasoline prices were a big drag on inflation last December, but the overall transportation sector seems to have increased more than what I was expecting.
What do you think about the dynamic on the food inflation side and how that will direct basically the Bank of Canada? Because they don't officially look at it in its totality, but clearly it plays a role in discretionary incomes for consumers.
Yeah, well, I think when we think about it as what the Bank of Canada will look, I think looking at more on the core measures, so for example, CPI median, CPI trim, are still moving in the right direction. Actually, CPI median is now at 2.5%, so it's quite a decent deceleration last month. So they kind of focus a bit more on that, and they take a more holistic approach on inflation and not just focusing on one part. But when it comes to food inflation, it matters. Like a lot of economists love to look at excluding food and energy, but at the end of the day, households spend almost 30% of their, or 20% or so of their disposable income on food items. So it has a big importance, and we've seen throughout, especially in the second half of 2025, a lot of what we've seen in terms of stickiness in inflation and increasing inflationary pressure has been driven by food, and that seems to be continuing again in December.
And just to pick up on Dan's note there about the Bank of Canada, right? Like I believe Tiff Macklem was saying if inflation stays around 2%, so 2.2 was enough to keep rates steady, you know, the Bank of Canada wasn't going to cut again. Is 2.4 high enough to see some change? I know you touched on that briefly, but I mean, could we see changes because of that?
I don't think on the surface, I don't see anything in the report today that would change my view on the Bank of Canada. My view is that the bank is really firmly happy with where rates stands at the moment. They're still willing and ready to act if needed. But at 2.4%, it's not an issue. And they've had warned that in the first few months of 2026, we would have some volatility in inflation, headline inflation, especially coming from changes in the GST last year, the carbon tax removal also in April, and that they will look through some of that volatility. So I'm not too concerned. What it will look more in that type of volatility is more what's going on under the hood. And so far, there doesn't seem to be any big worry at the moment on that side.
Have we seen the tailwind from lower mortgage rates now turn into a headwind? And how do you see that playing through and feeding through the inflation data? Because that's clearly a big part of the basket, if you will.
Yeah, well, that in mortgage interest cost is getting less and less of a push on inflation. We're seeing, yes, still people are renewing their mortgages at higher rate, especially those who bought in late 2020, early 2021, will see an increase in their interest. So that's still having a bit of a tailwind in inflation, but much less. Where we're seeing a lot more impact on the shelter cost is we're continuing to see more and more of that lower rent feeding into shelter, or less increase in shelter costs. And the same on the owned accommodation. We have house prices throughout Canada that have been drifting lower slowly, and that is going to put some headwind on that component of inflation, especially in the first half of this year. So I'm not too concerned on the shelter side for this year.
You talked about the fact that food prices, you know, we're continuing to see that trend where food prices, whether it's eating at restaurants, groceries, what have you, that's driving inflation up. But we're seeing, of course, you know, consumers paying less for gas in December. Is that also a trend we could see, maybe, that gas prices will continue to go down? And could that also level out?
Yeah. Well, that obviously the problem with gas prices is that it's so volatile. We never know, and I can just see it from here where I stand in Alberta. Like we had gas prices below $1 during the Christmas period, and now we're about closer to $1.30. So that's volatility. It's still low when we compare like $1.30 compared to what it was like over the past 2 years. Some the low end, but because the inflation is the month-over-month change, just that little change will push inflation higher in January if it was kind of just that component that matters. So yes, it still remains low, but it's still more on a trend. Where I'm a bit more concerned on food inflation is more how sticky it has been, but also you have to take into account that food being such a big part of the basket, either through CPI or either through the what consumer are spending, is that it has more influence on inflation expectations and other components, for example, like car prices. So that's where that stickiness in food prices could have or could mean some stickiness on the inflation expectations down the road. But with headline inflation around 2% or slightly above 2%, it's not something that would concern the Bank of Canada at the moment.
So when you think about just the idea of inflation expectations and how that filters through, especially through food, as you eloquently laid out, that normally means implicit wage pressure and that spiral that we've seen in more emerging market economies. But how do you contrast it with the lack of basically the building slack in the employment market? So will we have even that wage pressure that we would see in otherwise in economies where inflation expectations are climbing?
Yeah. Well, I see at the moment, like when we look at wages, is that there's not enough. Obviously, there's the amount of slack in the economy, the uncertainty with the trade policy and where the economy is going with all the threat from the U.S. It's a more difficult environment for workers to ask for better pay. And what we've been seeing mostly in terms of wage increase is actually wage increase to keep purchasing power constant. Actually, when we look at the data, real compensation of employees has barely changed compared to where it was in 2019. So we're barely making enough. We haven't seen any real gain in purchasing power based on just on compensation over the past few years. The only gain on purchasing power has been those households that have or that owns assets have seen greater return on those assets, and that's actually where disposable income has been increasing, or real disposable income has been mainly increasing for households.
Okay, that's all the time we have. Charles St-Arnaud, Chief Economist at Service Credit Union. Appreciate you joining us today and breaking down the numbers. Thanks so much.
Thank you for having me.
Still ahead, we are looking at why tech talent is leaving Canada with Red Thread social founder Mai Trin. And our phone lines are now open. Dan Rahinton, portfolio manager at IA Global Asset Management, is taking your questions on stocks today. You can call us at 1-855-326-6266 or email us firstcall@bellmedia.ca. Gen Z tech entrepreneurs are facing challenges in starting their businesses here in Canada. And that's why our next guest moved her company from Vancouver to Los Angeles this month. Here to talk about her journey as a tech startup in Canada to the U.S. is Mai Trin, founder of Internet Backyard. It's good to have you join us. Thanks so much. And Dan Rahinton, of course, still here as well. Thanks, Mai.
Thank you for having me.
So I guess just to start, can you tell us a little bit more about Internet Backyard, what it is, why it was created?
Yeah, Internet Backyard is a financial company for compute. What we do is that we automate the entire circle from quote to cash for data center, co-location, and neo-cloud, which is obviously very huge right now considering the demand for AI.
And let's talk about Red Thread as well, a community Gen Z startup for tech founders. Give us a sense of why this was needed, do you think?
Yeah, so I started this in the beginning of summer when I just graduated and looking for jobs, and I feel like I don't want a traditional jobs. So I start going to all the conferences and realizing that there's not really a space for Gen Z in entrepreneurship in Canada. So I posted a TikTok video, talk about how I want to create my own community and surround it with like-minded people. It blew up, and over 60 days, we got over 1 million impressions across media, and we have around 3,000 people in our community.
It's amazing. I'm curious, though. I mean, you felt you started your tech journey in Canada and then you left Canada. Can you explain why you felt you needed to leave Canada to really get this business going?
Yeah, so there's two main reasons. Number one is visa. So I'm an international student. I'm from Vietnam and my co-founder is from Brazil. For us to be able to get PR in Canada, we need to work on someone else's company for 2 years in order to qualify for enough score. And because the score keeps rising, we can't really do so while building our company. At the same time, the startup visa program in Canada is a 10 years wait time. It just doesn't work for us. And the second reason is that we were told that because we're building a fintech company, the infrastructure that you would need in order to launch quickly and scale successfully, it's only available in the state and not in Canada.
So when you think about really the decisions, it came back to government policy in some capacity, whether it's open banking in the case of the fintech, and the other part is basically a deprioritization of entrepreneurship in the Canadian economy. Are there quick wins you see from the policy perspective that could really help bring that forward? I think we'd all agree that open banking is a huge win for all of us, but we will be waiting another few years before that happens. But is there anything on the entrepreneurship side that is low-hanging fruit for Canadians?
Yes. So we see that there's a pool of talent that just in two hub spots. So you have Vancouver in the West Coast, and then you have Toronto in the East Coast. Majority, 83% of Canadian students after graduate, they just go directly to San Francisco or down to New York because it's so much easier to get working visa there for O1, H1B, or EB1. And that's a kind of policy that the government could change. But just last week, they just changed a new startup visa program where all 42,000 applications in the Canada startup visa got declined. And then now they're capping it at 500 applications per year. I'm sure we have more than 500 promising founders in Canada in a year.
I mean, are there more ways that you think Canada, obviously, as you mentioned, that new policy, maybe not one of them, but are there more ways that maybe Canada could be more open to allowing people to, have tech startups stay in the country?
Yeah, I think funding is a big part. For example, when we incorporate in Delaware and we raise our round, we raised $4.5 million on a $25 million pose. And it's very easy to close that round. We close in a week versus in Canada, in Western Canada alone in Q1 2025, the entire province in pre-seed round in total raised $3 million.
That's a stunning figure. And is it one of those things where we've seen attempts at, I think it was BDC Canada and other places that are trying to kick off a venture ecosystem? But maybe the honest question would be, is San Francisco too far ahead? Andreessen Horowitz just raised $15 billion. So even if we raise 30 million or 300 million, does it even matter at this point? Is venture capital, unless you're adding billions to the conversation, can we even catch up in that respect?
I do believe we can with the current economy. And I'm a big believer in if you want to do something, you could just go and do it. The real question here is the economy and how much the federal government is supporting young founders or even VC funds. BDC is the largest fund in Canada, but you have all the other micro funds that are supporting founders and really want to be there for first-time founder, but because they don't have enough cash, it's really hard for them. And the way they structure is really hard for them to match the terms of San Fran or any other VC in America.
And one more on my part would be just for your business that you founded, proximity to data centers, basically the access to tokens and compute, I would imagine is an important part of the conversation for you and other founders in a similar field, with basically every startup being an AI startup of some capacity from where we are today. If you look at Y Combinator or any of the big feeder funds, is having data center compute capacity available at basically low cost per token, is that a potential vector of competitive advantage that Canada can offer that's untapped for us?
Yes, that's absolutely right. So we have our first two customers for pilots actually in Vancouver, AC North and Pact Buildings. And we see absolute appetite for this kind of support in terms of growing the ecosystem. Compute is a huge part, and especially with the amount of water and energy and capacity that Canada has, we have huge land, we have a lot of waters, we have cooler temperatures, so it's very good for data center. It's a huge industry that can grow if the government is willing to support, especially when it comes to data center energy management.
So interesting hearing all of the things Canada has going for it for this. Okay, that's all the time we have, though. Mitran, founder of Internet Backyard, appreciate you joining us. Thanks so much.
Thank you for having me. Have a good one.
You too. Thanks. Well, still ahead, we will take a look at one of the notable analyst calls and recommendations moving the markets today. Stay with us. Let's take a look at some of the notable analyst calls and recommendations. We'll start off with Albemarle Corp. That was upgraded to buy from hold at HSBC. As analyst Ishan James sees rising lithium prices driving that stock higher. HSBC notes Albemarle's free cash flow and balance sheet have been improving on lower capex, increased capital raises, better efficiency in the sale of non-core businesses. HSBC has raised the target price to $200, up from $117. All right, when we come back, Dan Rahinton, portfolio manager at IA Global Asset Management, is going to be taking your questions on First Call. That's next. Stay with us. Welcome back to our First Call segment on the street. Joined with Dan Rahinton today. He's going to be answering your questions, and we're going straight to the phone lines. Demetra is calling in from Fredericton, New Brunswick, with a question. Good morning. What's your question?
Good morning. Hi, Lindsay and Dan. Great host and the guest. I have a question about Lumen Group, part of the Constellation family. So on the theme of software businesses selling off, a question for Dan, whether does he think that market worries are warranted specifically for vertically market integrated software businesses? I'll hang up and listen. Thank you so much.
Okay, thank you for that. Dan, what do you think? I mean, is this one of those software companies?
This is exactly one of those, call it software companies that are in legacy industries that are trying to basically hoover up their share and extract rents out as a part of that. That works really well in a pre-large language model, foundation model, AI world. So I think I'd be a little bit careful here, because just because the stock used to be at $50, it's not written in stone anywhere that that's the direction of travel on the way higher. So when you think of Lumen Group, it's plugged in, it's locked in, there's what's known as in software vendor lock-in. But at the end of the day, if it's easier to see, your customer base is seeing some pressure as a whole, so budgets are being cut. The second part is a competitor can come on at a fraction of the cost. So even if you don't get replaced, you lose your ability to take pricing. So I'd be cautious about this one.
Interesting. All right, we're going to move to an email now. This email is from Bill, and it reads, short and sweet, what are your thoughts on Capital Power? Ticker is CPX. What are your thoughts on Capital Power?
Yeah, I think it's interesting. When you think about Capital Power, there's the Alberta piece, Genesee 1 and 2, and the excess capacity they have there. But Alberta's a little gun-shy on letting the big data centers in for grid reliability reasons. So you have to look at their exposure in the United States in PJM, which is a very hot power market. And this company should be well-positioned and trades at a discount to its peers, Talon Energy and Vistra, which are very much in the same space. So I'm a buyer. I think it's interesting. Although you have to understand that you own the tail end of the AI trade, which is you start with TSMC and NVIDIA and Avagos of the world, all the way down to the power player, where power is over time a commodity, but we're in such a super cycle for power that this is worth buying. I'm a buyer.
You're a buyer. All right. We're going to go to another email, this one coming from David, and it reads, why has Fairfax price fallen and is now a good entry price? And Fairfax Financial down the most it's been in 9 months.
Yeah, that's the power of the alternatives going up. So Canada, think of Canada as a closed stock market in some capacity. So if you're buying TD Bank, you're probably selling a little bit of Fairfax as a portfolio manager, and back and forth we go. So what you're looking for in the Fairfax thesis is continued stability in underwriting, the ability to push costs through, and investments in the investment portfolio that don't look like the tech shorts of Prem Watsa from 10 years ago. I think all of that is true. I think Fairfax is interesting, but you have to understand you own a low beta defensive stock in a TSX that's running hot on materials and financial services, and this is defensive financials, so it's a source of funds. But I'm a buyer because I'm a contrarian on this stock.
Our last email coming in from Jimmy. This one reads, I like your thesis with respect to the USA, strength versus weakness in geopolitical strategies. Do you consider the overarching economic supercycle in K-wave theory and other close watch calendars around the globe?
Yeah, I think K-wave theory, if our memory serves, talks about basically the idea of boom and bust cycles through different developed capitalist economies. I think that might be trying to overfit a conversation. The best way to think about it is the U.S. As our southern neighbor is the greatest hyperpower the world has ever seen. So the U.S. is basically in a grand contest because when we talk about a world of hegemony, that's what we had since the fall of the Berlin Wall. So 1989 to say 5-6 years ago, we had U.S. hegemony. So that was Pax Americana. Now we're moving into multipolarity and all the volatility and problems that come with that. So everyone who's excited about multipolarity, congratulations, you got your wish. Now what comes next is basically the pieces on the chessboard. And that's really what's going on. So I wouldn't look towards broader things.
Okay, that's all the time we have. Thanks so much for answering all those questions, Dan. Appreciate you coming in. Appreciate your time. And that's it for us today on The Street. Andrew Bell with The Open is next with markets opening just over 30 minutes from now. Stay with us.